The U.S. economy adds less jobs than expected in August. Meanwhile, job additions for June and July were also revised downward. So the question of a recession lingering as the Federal Reserve prepares for its next interest rate decision. Here to discuss, New Century Advisors chief economist and former Federal Reserve Board economist Claudia Sahm. Claudia, it's always great to see you, especially on Jobs Day. So first, just wanted to get your high-level take here, not just on the jobs numbers, but what you think the Fed is now likely to do.
So the latest information that we've gotten about the labor market is not good. It's not terrible, but things are slowing down. They're pointed in the wrong direction. And it is absolutely clear what the Federal Reserve needs to do right now. The labor market is slowing down in part because of an intention by the Fed to slow things down, to get inflation down. But I mean, the effect, and we knew this was coming, was the labor market would slow down. And it's time for them to ease off. Right, like this is getting to a place where these numbers, while they're not recessionary, these aren't good. And we're really, the labor market that has been great for the past years is starting to really slip.
So, Claudia, would you recommend, a traditional 25, or do you think 50 is warranted given the data you're seeing?
Given the data that we have seen since the July FOMC meeting, right? So we've learned a lot in the last 2 months about the labor market. A 50 basis point cut would be appropriate and warranted as a recalibration, right? We've not just gotten two disappointing jobs reports. We got a large preliminary estimate of an annual revision to payroll gains. Things have been slowing down much more, both in terms of there's less job creation, and the trend is worse, looks worse than anybody could have known sitting in July, looking at the data. So there is an argument to make, hey, we should have got going. We're going to do a little bit of catch up and then go ahead. It is not a 50 basis point in the bottom is falling out, the recession is nigh. It's just, hey, things are slowing, and we misjudged how quickly they were slowing, and we're going to get on top of it. Because again, the federal funds rate is over 5% right now. 50 basis points is not the first cut that needs to be done. We have a whole series, and it's better to start moving with some real purpose here and respond to the data, to what we're seeing in the conditions, because the labor market will continue to soften.
Claudia, I want to ask you sort of a wonky economist data question. So stick with me here for a moment. And this was brought to our attention by Omar Sharif of Inflation Insights. His comment was picked up by Sherwood. They looked at he's looking at the 3-month average of payrolls over the last 3 months, including today's revisions. And that 3-month average is now 116,000. But if you look at this little note that he pointed to in the BLS, which, to be fair, I never noticed before, they are 90% confident that the job number is correct within a range of something like 130,000. So 116,000 is less than 130,000, which I guess means that there is a chance that there was actually, it's probably not a big chance. I guess what I'm getting at is, to your point, there are so many revisions. How do we read these numbers when there is such this range and all of these revisions?
So we need to understand the data are imprecise. They are subject to revision. Revisions are a sign of how high quality our data are. Like, we get numbers really fast, and we have statistical agencies that put effort into making sure that over time they get better and better and more accurate. Right. So, but that means that when you're doing decision making in real time with the imprecise numbers, you do things like take the 3-month averages, look across different series. It's not just about payrolls. It's not just about unemployment rate. You really have to breathe it all in. And one thing that I think particularly that I have spent a lot of time looking at now are like, what are the contours of the data? Right. What Powell told us in Jackson Hole is they don't want to see further cooling. Right. Like, what's the direction of travel look like? And so you try to move away from, there is no magic number. Right. And to make policy or to make an assessment of the U.S. labor market or economy in general, you have to look at lots of different pieces of data. And yes, being very aware of these are imprecise numbers and they will change, but you got to kind of high level.
Yeah.
Claudia, given what you saw in the report today, interested also to get your updated thoughts on the state the health, the resiliency of the American consumer here, Claudia? I mean, we're always looking for clues. You know, you go through this earnings season and you listen to the CEOs and the CFOs running our companies, and I think there was a note of caution. You know, you heard a lot of talk about a consumer that's selective, right, discerning, focused on value. I'd be interested to get your take.
Right. When we see something, so I think for the consumer, you will continue to have that theme of some uncertainty, some caution. And we see that with employers too, in terms of their hiring decisions, right? And this isn't just about the Fed that's weighing on people as they kind of think, what's the next move? But with the labor market slowing, and again, it is not in a crisis place, but as it slows, the labor market is so important to most American consumers in terms of their spending patterns, particularly their ability to go out and make the big purchases, spend more. And so right now, if you have a labor market that's doing okay, but slowing down, like, again, the direction we're headed here is not a positive one. And it doesn't have to, like, the recession is not the only bad outcome that we could face. Just something slowing down, that is its own, I mean, that's something we want to try and avoid as well.
Something we have been talking less about, you know, usually the discussion is sort of binary, recession or no recession. But you just touched on something, which is, what will the recession look like? One of the things I was looking at, in addition to looking at the Sahm indicator, of course, was just looking at the absolute unemployment rate going back in recessions in the post-World War II period. Usually, particularly in the last, say, 40 years of recessions, the unemployment rate is not quite as, it is less benign than it is right now when you head into a recession. So does that imply that if we do go into one, it won't be as severe, or that if there's a slowdown, it won't be as severe? Like, how do we get the color on the recession, if you will?
I would caution against any analysis that really hinges on the level of the unemployment rate. So when we think about, you know, tracking the recessions and the work I did with the Sahm Rule, it was all about the changes, because we have gone into historically recessions at very low unemployment rates, and we've gone into a much higher unemployment rates from now. A reason why a fairly low of a 4.2% unemployment rate, that is historically, you point out, yeah, that's a good number. Well, we also have a much more experienced and older workforce just by demographics. We would be expecting, and like Congressional Budget Office is one that does estimates of this, we would expect an unemployment rate to kind of, you know, if everything is, you know, in equilibrium, all doing fine, to be not that much higher than where we are. So whereas in the 1970s, when we had a much younger workforce, that rate was much higher. So you have to be careful about those levels. You know, but this idea of, I think if I were going to point to where we are better positioned to buffer some of the stresses that you might see in a recession, or you know, a lot more weakening in the labor market, we do have households that tend to have better balance sheets. Not all households, but in relative position, we have come to this place with, you know, we've had some good jobs, good incomes, wealth has been higher coming in. So I'd look at that piece of it as opposed to, you know, the level of the unemployment rate relative to history.
Point taken. Claudia, always good to catch up with you. Thanks a lot. Appreciate it.
Great. Thank you.